There's a tax strategy available to almost every Canadian retiree right now that lets you legally realize tens of thousands of dollars in capital gains at a very low tax rate, sometimes close to zero. Reset the cost basis of your appreciated investments for free, so to speak, and dramatically reduce your tax bill for the rest of your retirement. It's not a loophole. It's not an aggressive tax planning. It's not something you need an offshore account or an accountant in a suit to set up. It's a strategy that has been sitting inside the Canadian tax code in plain sight for decades. Every single number and rule I am sharing with you is completely studied and based on official Canada Revenue Agency guidelines. And you can verify all the official sources and tax documentation linked fully in the description below. And after 15 years of examining retirement systems, I can tell you that the vast majority of Canadian retirees I sit down with have never heard of it. Their accountant has never mentioned it. They walked into their RAF years paying thousands of dollars in capital gains that they could have completely avoided. In this video, I'm going to explain exactly what the strategy is, why it works so powerfully in Canada specifically, the real numbers on what it saves you, and how to execute it step by step, and the mistakes that have ruined it for people who try to do it without understanding the rules. My name is Dr. Elizabeth Thorne, and the strategy is called capital gains harvesting, and by the end of this video, you're going to wonder why no one ever told you about it before. Let's get right into it. And quickly, if you want me to look at your own specific situation and figure out how to use the strategy for your own portfolio, there's a link in the description below to book a call. It comes directly to me and my team. Now, let's start with what this strategy actually is. What capital gains harvesting actually is. Capital gains harvesting is the deliberate selling of an investment that's gone up in value specifically to realize gain at a lower tax rate, and then immediately rebuying the same security or same investment to lock in a higher cost basis. Let me break that down because it sounds more complicated than it is. When you buy a stock or for ETF in your non-registered account for, let's say, $50,000, and it is increased in value to $100,000, you have a $50,000 deferred capital gain sitting inside that investment account. The gain is unrealized, which means you haven't paid tax on it yet. You only pay tax when you sell. Now, here's the thing most retirees never think about. The tax you'll pay on that gain depends entirely on what other income looks like in the year when you sell. If you sell when you're still working full-time, you'll pay tax at your highest marginal tax rate. If you sell in a year where your taxable income is low, you'll pay very little or nothing at all on that gain. Capital gains harvesting is the strategy of deliberately choosing the year you realize that gain. You wait for a low-income year, you sell the appreciated investment. You pay almost no tax or a very little tax on that gain, and then you buy the same investment back the next day to lock in the higher cost basis. Now, your cost basis is reset at $100,000 instead of $50,000, and the next time you sell, you only pay tax on growth from that new higher number. Most Canadians never think about timing capital gains. They sell when they need the money. They sell when they're rebalancing the portfolio. They sell when they think that the market is at a peak. They never sit down and ask the question, what is my tax bracket going to be this year? And should I be triggering gains intentionally because of it? That single question, asked at the right time, can be worth tens of thousands of dollars over 25-year retirement. Why does it work so powerfully in Canada? Here's the first reason this works in Canada. Capital gains are only 50% taxable. That means if you realize a $50,000 capital gain, only $25,000 of that gets added to your taxable income. The other $25,000 is completely tax-free. Already, that gives you a significant advantage over regular income, which is 100% taxable. But it gets better. The second reason this works is the basic personal amount. In 2026, every Canadian gets $16,452 of income completely tax-free at the federal level. That's the floor. Below that number, you pay nothing. So if your only income for the year is the taxable half of a capital gain, you can realize up to $32,904 capital gains and still owe zero federal tax because the taxable half is $16,452, which sits exactly at the basic personal amount. And the third reason, the one that makes this strategy genuinely powerful for retirees, is the low-income window in early retirement. If you retire at 62 or 63 and you have deferred CPP and OAS to 70, you have roughly 7 to 8 year window where your taxable income is dramatically lower than it was during your working years and dramatically lower than what it will be once government benefits start flowing in. This is the same window I have talked about for the RRSP meltdowns, and it's the same window that makes capital gains harvesting work. You have got the lowest tax years and lowest tax brackets of your entire life sitting wide open. Every dollar of room, though, in those brackets that you do not use is dollar of tax-free realization that you're throwing away. Most retirees walk through this window without using it. They live off of their TFSA. They let their RSPs grow. They let their non-registered investments compound. And they do not realize a single dollar of capital gains during the most tax-efficient years they will ever have. Let me walk you through a real example so the numbers actually stick. Robert is 63. He has retired last year, and he and his wife have CPP and OAS deferred to age 70. So for the next 7 years, their main income is roughly $20,000 from withdrawals from their TFSAs and small amount of dividend income coming from the non-registered portfolio. Inside that non-registered account, Robert has a portfolio worth $300,000. He bought this about 15 years ago for $150,000. So he's got $150,000 in unrealized capital gains sitting inside a portfolio. Here is what would have happened if Robert does nothing. He keeps the investments, the portfolio keeps growing, and eventually he needs to sell some of it in his late 70s. By then, his CPP, OAS, and RRIF income have pushed his total taxable income to around $80,000 per year. When he finally sells $50,000 of those investments, he triggers $25,000 in capital gains, the appreciated half. That gets added to his income, and he pays roughly 30% tax on that. So that's $7,500 in tax on single $50,000 sale of these investments. If he sells the entire $300,000 over time at that tax rate, he's paying roughly $45,000 in tax over the rest of his life on those gains. And here's what happens if Robert uses capital gains harvesting during his low-income years. This year, Robert deliberately sells $30,000 worth of investments. That triggers $15,000 of taxable capital gain. The 50% inclusion added to his existing $20,000 income, the total taxable income now will be $35,000. After applying the basic personal amount and his other credits, Robert pays roughly $2,800 in federal and provincial total tax on realized gain of $30,000. So his effective tax rate is just over 9%. He then immediately buys the same investments back at the same price, but now he's setting his cost basis higher. Now, if those investments ever get sold in the future, he only pays tax on growth above the new cost basis. Robert repeats this every year for the next 6 years of his low-income window. He can realize the entire $150,000 of deferred capital gains at an average rate of roughly 9%. That's roughly $13,500 in total tax. Compare that to $45,000 he would have paid if he was to do nothing. That's roughly $31,500 of the tax savings from one strategy used at the right time. And here's the part most people miss. The $31,500 of saved tax doesn't just stay in his pocket. It stays invested. It compounds over the rest of his retirement. That single decision is probably worth $60,000 or more. All from understanding when to realize gains and when not to. And if you're sitting there thinking it sounds great, but you have no idea whether your portfolio has deferred gains or what your tax bracket actually looks like, that's exactly what I help people figure out on a daily basis. There's a link in the description to book a call. It comes directly to me and my team. Now, let's talk about how to actually execute this. Step 1 is to figure out what your taxable income looks like for current tax year. Add up your CPP, OAS, RRSP, dividend income, interest income, and any other taxable income. Subtract your basic personal amount. What you're left with is your starting point. If you're in your low income window, your taxable income is probably somewhere between $0 and $50,000. That's your room to work with. Step 2 is to identify the investments in your non-registered account that have unrealized capital gains. This is just a matter of looking at your most recent statement. Compare what you paid for each holding, your adjusted cost base, to what it is worth today. The difference is the unrealized gain. You should be focusing on the ones with the biggest deferred gains. Those are the ones giving you the most benefit from the strategy. Step 3 is to calculate how much you can sell this year without pushing yourself into a higher tax bracket. Remember, only 50% of the gain is taxable. So if you got $30,000 of room in your current tax bracket, you can realize up to $60,000 in capital gains and stay where you are. A simple online calculator can help this, or your accountant can run the numbers for you in 5 minutes. Step 4 is to actually execute the sale. You sell the appreciated investment through your brokerage account, the trade settles, and you realize the gain. The taxable amount gets added to your income for that year. Step 5 is the key part. You immediately buy back the same investment or substantially similar one at the new market price. Your new cost base is now the price that you just paid. Important point, the superficial laws rule, which prevents people from harvesting losses and immediately rebuying, only applies to losses, not gains. So you can sell it again and rebuy the very same day, same investment, same ETF, same stock. There's no waiting period. Step 6 is to repeat this every year you're in a low income window. Each year you use up the tax room you have available. Each year you reset more of your cost base. Each year you permanently reduce the tax bill you'll face when your income goes higher later. Done correctly, this strategy could eliminate most of the capital gains in your portfolio that you would otherwise pay over the 25-year retirement. The mistakes that ruin this strategy. The first mistake is realizing too much capital gains in one year. People hear about the strategy, they get excited, and they try to harvest $100,000 of gains in a single year. That extra income pushes them into a higher tax bracket, triggers possibly OASG's clawback, and ends up costing them more than just leaving the investments alone. The fix is to spread the harvesting across multiple years. Use the room you have. Do not try to do 5 years of work in one tax year. The second mistake is forgetting about the provincial tax. The basic personal amounts and the lowest tax brackets are different at each provincial level. Realizing $30,000 of gains might be tax-free federally, but will trigger a few thousand of dollars of provincial tax, depending on where you live. The fix is to look at your combined federal and provincial tax situation, not just one or the other. The third mistake is doing this while OAS is flowing in. Once OAS starts, every dollar of additional income above clawback threshold, which is $95,323, costs you about 15 cents of OAS. So a capital gain that looks tax efficient on paper could actually cost you more than you think once you factor in the lost OAS. To fix this, do most of your capital gains harvesting before OAA's dots. And that's another reason why deferral window retirement to age 70 is so valuable. The fourth mistake is forgetting that any dividends or interest in your non-registered account are still added to your taxable income every single year. If your account is paying you $5,000 in dividends and another $3,000 in interest because of the dividend gross up, that's about $10,000 of room that is already used up before you realize a single dollar of capital gains. The fix is to factor in your existing investment income when you are calculating how much harvesting room you actually have. The fifth mistake is doing this without a plan. The biggest tax savings come from coordinating capital gains and harvesting with your RRSP meltdown, your CPP timing, your OAS deferral, and your TFSA contribution. If you do one piece in isolation without thinking about the others, you can accidentally push yourself into higher tax bracket or trigger a clawback. To fix this, think of capital gains harvesting as one piece of an integrated tax plan, not a standalone trick. The retirees who get the most out of the strategy are the ones who layer it into broader withdrawal sequence that's been thought through from the start to finish. That's the strategy, but here's the thing. Capital gains harvesting only works if you built it into a broader retirement income strategy. And the single biggest piece of the strategy for most Canadians is the RRSP meltdown. That's exactly what I break down in this video right here. I go over the complete RRSP meltdown strategy from start to finish, including the 3 phases, the sweet spot, the 5 biggest mistakes, and exactly how to execute it for your situation. I'll see you there.